Well, Brian Hale, it's good to see you again.
Good to see you, Greg. How you doing?
Pretty well. Pretty well. This is becoming a regular occurrence, and I guess maybe this will be happening more and more. I always love seeing you. 40-year plus veteran of the mortgage industry, someone that's been involved in so many transactions over so many different years and periods of time. And this is a flurry. And we've got another one. Bayview acquiring Guild. I guess we got the tea leaves on May 23rd in the Schedule 13D. It flew past me. Bayview made the announcement that they were interested in Guild, and Guild responded by saying that they too were interested in engaging in some conversations. And then voila, here we are close to 30 days later, and we've got a deal. What are your thoughts?
Yeah, look, so first of all, last week at the gathering where I saw you there, I was supposed to interview Terry Schmidt, the CEO of Guild, as part of my panel, along with Dan Snyder from Lower. And the story that morning was Terry was sick, so sick she couldn't get on a plane. We had a stand-in who did a fabulous job. I was communicating with Terry a little bit, and I think she was absolutely sick, but I'm also highly confident that the lawyers said, you're not going on a public stage anywhere. And so I had a pretty good sense at the time that I had read the announcement of the original 7.3% investment. And I thought, okay, this is going to happen. Actually, I was talking to somebody who you and I both know, highly respected in the industry. And they're like, there's no way this is not going to happen, literally yesterday morning. And I thought, no, this is going to happen, because being public as a mortgage company today in the current environment has got to be a nightmare, and it's expensive. And you don't really get any upside value from being public today, right, in the process. So I think this is a huge accomplishment for Terry and the board, for Guild. It's a great investment, I think, for Bayview, Lakeview, right, through their subs. You see these combinations of production companies and servicers, but this is not terribly different, in my view, than the Rocket, Coop, Redfin deal, where, okay, now you've kind of put the pieces together. Now you actually have to execute on what is the promise. And it's not clear to me yet what they're, I read through everything that's public. Clearly the ability to originate, retain, build customer for life strategies, which has always been, part of Guild, at least. Although, like a lot of other lenders over the last couple of years, they've sold some servicing along the way, mostly because people need to. And so it's going to be an interesting ride, but getting out of the public space has to be a huge positive, and I see it as a material advantage for Guild. And then, Bayview has been investing in a lot of places in the industry.
What a turnaround for Guild. When I say turnaround, I don't say it from the vantage point that they were failing.
No.
If you think about their evolution, and in 2007, they underwent a significant management buyout led by then CEO Mary McGarry and COO Terry Schmidt at the time,
right,
in a partnership with McCarthy Capital. And what an investment for McCarthy Capital and Terry Schmidt. Wow. Now, this is a victory
for her.
Yeah, it's also a victory for women in our space.
Yeah,
it's amazing. We don't have enough women leaders in this space, and I don't want to go on to my soapbox here, but man, let's celebrate today and this accomplishment. And it's quite remarkable, right? And then in 2000, so they did that in 2007. They had some acquisitions between then and 2020 when they went public with the help of Bayview, who then took on a stake of the company. And as of today, they already own 7.3% of the company. They'll soon own 100%. It's just, and then the timing, right? You don't want to be public right now, as you mentioned, and there's so many things happening. And you mentioned what it looks like and what they might be thinking. You've got 2.8 million customers on the Bayview side, and you've got 2,000 originators on the Guild side. So on the surface, from 10,000 feet, it makes sense. Obviously, what you're referring to is, hey, how do you get this off the ground? How do you retain? Because at this moment, you better believe there are hundreds of Guild originators getting called right now. So a lot to unpack.
Every recruiter this morning got up, hit their feet on the floor, and started dialing Guild originators. Right? That's clear. I've got text all morning from clients going, "What do you think? Who do you think I should go after first?" Right? That kind of stuff. So I think you got to retain. Look, Guild has built a nice mousetrap for originators. I think they've done a pretty good job retaining. They've, like everybody, they lose a few along the way. They've gained a few along the way. But look, here again, I have a lot of respect for both parties in this transaction. I thought Marianne did a great job leading that company through its evolution. I thought Terry was her partner through the process, and she's carried on. David, everybody in the senior team there are really strong players. The challenge now, different than the Rocket Coop Redfin deal, is you're dealing with distributed retail originators at Guild, who, as you know, because you oversee a number of them in your past life and your current life, are not always easy to direct or coordinate. And so the fact that you got 2.9 million customers on the servicing port now, first of all, they weren't all Guild customers. So it's not an automatic, hey, we're all one big family. Two, really successful originators, I have found, have a tendency not to want to focus on leads coming out of a portfolio. So it's not super easy, but like the other deal, I think, you pile up this lump of clay on the potter's wheel. Now you have to make a beautiful vase out of it. That's the challenge, right? How do you create what should be the promise of these two companies come together? The big advantage, in my view, for the combined group and for Guild in this process is, and I think for the most part, Marianne and Terry have always, and I think the board has often looked long-term, more so than you would expect in a public company. But you get rid of this every 90 day talking to the stock analyst BS. That's not helpful in the mortgage space, which is, if you're going to be in the mortgage business, you got to be a holder for 10 years. You got to have a longer horizon. You're going to make a lot of money some years. You're going to make some money other years, and you're going to lose some money. And Guild has suffered through all of that. They've done a great job in having a vision. They've built it. They've acquired. They've added to it. And now this is like the next evolution. What do you do from here?
You're always so wonderful at breaking down the financial component. We talked about some of these other deals that have happened. The Redfin deal seemed like a fire sale, almost. Very little, if any, cash traded hands. There was a lot of stock.
Particularly a fire sale if you bought the stock when the company was valued at $10.5 billion.
And
it sold for 1.8, right?
Yeah. So let's look. Can you look at this deal and tell us what you think about the numbers here? On paper, it looks like there's a premium paid.
Look, what it validates is what I tell M&A clients, either targets or a couple of customers I have currently that are in the market looking to acquire. If you look at most IMBs today, the trading range, and people have all different views, but for the most part, the trading range is, if you're losing money and you want to sell, you're likely going to sell at a discount to book. And if you're losing a lot of money, it's going to be a big discount to book, because really you have a fire sale, right? You've got X amount of cash on the balance sheet. Your cash is running out. You might have 6 months left. You're going to sell. If you're break even or better, you can sell at book, maybe plus a kiss, so a little bit above book. But if you're profitable and you're growing and you got a good management team and you got a nice franchise, which Guild has all of those things, it's sold at a premium, to book. 1.27, I think, is what I read. 27% premium to the last close price. So, I think it's a very good deal for Guild stockholders. It's a great deal because it's not like double stupid, 8 times book or something like that we saw back in 20 and 21, where we saw some goofy deals, particularly when companies went public. So it's a reasonable value for the acquirer, a decent premium for the seller, and the promise being that 1 + 1 here should equal 6. Now they got to go execute on 6. That'll be, that'll next year after, it'll be interesting to see how does the combination work. And I would just add, and I've said this to you before, is this the last party to be connected to this pair? So, is there a desire to go out and acquire, a portal? Is there an acquire something else? Are they going to continue to be a very aggressive acquirer in the retail space? Is there a desire to acquire a consumer direct where you have 2.9 million customers now sitting in the port? recognizing that your retail originators, while they say, yeah, send me the leads, they're often not great at conversion.
Yeah, for sure. Where does this leave historically companies like Academy that were gobbled up by Guild? I mean, when those kinds of
They're
deals
along for the ride.
along for the ride.
Yeah, look,
So,
I think for the most part, I had dinner a couple of weeks ago with one of the Academy divisionals that's now a divisional at Guild. And I think, my general sense is that group, it's a big group, has fairly well settled into Guild, found the value of Guild. And look, this, there's not an originator in the industry who says, or retail sales leader who says, everything here is perfect, right? There's no perfect answer. So people have issues. Welcome to the mortgage business. But my general sense is all those companies are integrated. Rick, who sat on my panel at the gathering, was the president and COO of Cherry Creek that sold to Guild. And that group is fairly well integrated. And so, Bayview ends up getting a bigger entity than maybe they originally thought they would. Right.
Yeah, well, let's talk about what does their firepower look like? What can they line up here? They've got, I believe, over 20 billion in assets under management, and they've got some links to insurance companies.
Yep. I think I just read they have like $1 billion in cash.
Is the next step to build the flywheel?
Yeah, I think so. Look, I emailed the congratulations to Terry this morning. She was gracious enough to respond. And I think they're very excited. Again, I had the good fortune or unfortunate at one point in my career, I had publicly traded bonds. I wasn't public as a company, but I had publicly traded bonds. So I had to go through the earnings calls and the 8Ks, the 10Qs, all that kind of BS that has real cost and, worse yet, immense distraction to the senior team, particularly the CEO, right? So this, I'm going to guess, I don't know this exactly, I'm going to guess Terry just picked up 30 to 40% more time on her calendar to focus on strategic issues relative to Guild versus dealing with being a CEO of a publicly traded company, talking to investors, talking to analysts, talking to, rating agencies and all that kind of stuff. All that, for the most part, goes away. And so now you can focus on the key business of the day. And look, I believe that M&A is nowhere near over here in our space, in the mortgage space. And so, you could see them go down the path of a tech company. You can see them go down the path of a consumer direct company. There's home equity companies out there. So just start thinking what the flywheel could look like. They're backed by a lot of capital. And, oh, by the way, Bayview has some very big backers behind them, like the Blackstones of the world and BlackRocks of the world that are in there with capital as well. So, I think, by the way, to answer your question, for the right deal, they have unlimited capital. Why? Because they got a bunch of stockholders who have access to effectively unlimited capital for the right transaction and the right return.
All right. So when things like this go down, obviously you read all the right things. Management's going to stay in place. That nothing's going to change. The brand's going to be the same. What does change is who owns the company.
That's right.
And so,
can
you give us a window? Can you give us a window into the potential pressure points that the former owners might face on a consistent basis? You got to hit your numbers. You've got certain quotas. Yeah. Obviously, they put up a lot of money. So how could that dynamic change things? Could it change margins? And there's a lot here.
I don't, look, it would be shocking to me if a Bayview, Lakeview got involved at how are we setting our margins level of conversation, certainly anytime soon. Maybe if things were going badly, that's a different answer. But I think if there's any pressure, and I felt this, frankly, when we sold Stearns to Blackstone, there was an immense pressure to deliver MSRs, as an example, to then Lakeview, which was a predominantly Blackstone-controlled company at the time. Isn't anymore, but was at the time. And frankly, the economic opportunity for my MSRs was better away from Lakeview at that time for two reasons, by the way. Because one, I think Lakeview, Bayview have some of the smartest asset buyers in the industry. They understand the math. They're very good at it. They're really sharp pencils. And, they're a believer in buy low, sell high, right? Not buy high, sell low, right? So that I had debate at the time. I could get another 40 basis points by delivering the loans to a Freedom versus to an in-house entity. Well, if you're sitting at the very top as the stockholder, you'd like to have the transaction be kind of in-house, right? Because you're enhancing both companies. If you're an executive running the business, depending on how comp plans are structured and, those kinds of things, you have a slightly different view, maybe a materially different view. Who knows how all that'll work out? But people who invest billions of dollars are looking for outsized returns consistently. And so that's where the pressure comes from. But I don't think that's materially different than being in the public space. Maybe a little bit in that, a stock analyst or an institutional investor is not going to send a wave of Excel jockeys at you.
Hey, Brian, you mentioned Freedom Mortgage.
Yep.
And I mean, this is really fascinating to me. I'm going to take it down a path here. I mean, they sat back and watched Mr. Cooper get absorbed by Redfin, which Stan Middleman told me opens up opportunity for him. I think we all know that, right? Because all of a sudden people aren't going to want to sell to something that has a retail presence, right? And now he's sitting back and here we are. We've got Lakeview. They're one of the biggest servicers, right? So to me, Stan just keeps picking up market share without making any moves.
Maybe. Look, I don't know that that's how decisions are made on an ongoing basis. I still think, look, I was on a webcast the other day with Polly, and we had the head of capital markets, Gary Mullis from PRMG, was on the call with us. One of the smartest guys, I think, in the capital market strategy area in the industry. And listening to him talk about best X in his mind, right, as somebody in charge of optimizing revenue, it still comes down to the bid price. And look, I think to your point, I mean, you saw UWM react, right, when Rocket acquired Coop, and because Coop held a lot of MSRs that UWM had produced, and now they're going to supposedly pull it all in-house. It's going to be great, super, whatever. We'll see how that executes. I think some people would look at that and go, well, I don't necessarily want to send my MSRs there for the following reasons. By the way, that tends to fade away when things are tough and the bid is good.
Well, and there may not be, if this keeps heading in this direction, you might have all the servicers in the mortgage game.
Yeah, so you could exactly. You could have a lot of, first of all, Stan has an outstanding consumer direct group for recapture. So it's not that he doesn't have retail. He just doesn't have distributed retail, right? And so he is, I think Freedom is one of the best at recap and doing those kinds of things, which answers why they tend to pay up for MSRs, at least been my experience, because they're fairly highly confident on the recapture capability. So I think you can run, but you can't hide from this kind of consolidation, recognizing that big servicers are in the business to hold that asset as long as they can and or to recapture it whenever they can.
So if you're a private equity firm or VC, whatever, and you're seeing all these folks dive in head first, does that create a FOMO, do you think?
Yeah.
So let's talk about that dynamic and how others might be looking at this going, how do we get in this game?
Yeah, for two reasons. And I think I said this a little bit on stage last week. I think you were in the audience, but my own view, and I've got Mike Frattantoni coming on Friday on the weekly roadmap on my podcast at 9 a.m. Pacific, if I can pump that. But
of course you can.
To talk a little bit about a mid-year view, right? What happened to his forecast from November, right? The first 6 months of the year, which has been a little different. And then what does he see in the second half and in 26? No matter how you cut it, I think we're probably later in this down cycle than early, meaning somewhere out there, the sun will begin to shine again, right? I think it's 26 personally. I don't think we're going to get a lot of rate relief this year. If we do, it'll be marginal. It's not going to be something that, fixes the industry overnight. But I think there's a lot of money on the sidelines thinking is now the time to buy, recognizing you could still have some difficult, maybe it's 6 months, maybe it's 12 months, maybe it's all of 26, I don't know. But at some point, the mortgage business, I'm wildly bullish on the mortgage business for demographic reasons. You have, if you take the second half of Gen Z, the millennials and Gen X, you have 2.5 times the population of the baby boomers. They're all moving into forming families and buying houses just like the boomers did ahead of them. And so the future of real estate and the future of mortgage banking is wildly bright. The question now becomes, when do you buy in? And so I do think as you start seeing these big pieces coming together in mergers or acquisitions, I think there is a sense of, holy man, if we're going to go, we better go. And I was talking to somebody today that I think is now moving in that direction, a big player moving in that direction and thinking maybe it's time to move. We got a nice growth jag going. Things are going pretty well. Now's the time.
Is there any scenario where all these people putting their money on the table and going all in or making their bets where they could be wrong?
Oh, of course.
Yeah. Okay. Yeah. I don't mean on a deal by deal basis. I mean this idea that it's about owning the consumer and the servicing and the flywheel, and that the consumer is just going to fall into line and want one entity to handle every single aspect of the transaction. Is it possible that we look ahead in 10 years and go, man, that didn't work out?
Sure. Look, first of all, mergers and acquisitions in our space, if you look over the last 30 years, not the last 2 years or 3 years, most acquisitions in the mortgage space have not been a success. People tend to leave. You buy an empty box. There's all kinds of issues that went on. People weren't thoughtful about how to combine the cultures. Frankly, the old Wells Fargo Norwest used to do the best job at it. When they bought the old Director's Mortgage, this goes back a long ways in this process. The point being is there's probably two things that really are preeminent that could go wrong. First of all, and this is Brian the Bear, I think there's a 30%, maybe higher percent chance that rates go up from here on the second half of the year and into 26, putting immense margin and volume pressure on the industry. So when you're trying to combine these entities and the economics, the underlying macroeconomics of the business get tougher, everything gets exposed. So if you have a little bit of a rub, it becomes a bleeding wound, right, in the process. So the market could impact it. And then secondly is poor execution, right? Where you think, okay, I add A plus B plus C and it should equal, great. And then you screw up the combination, or your approach is wrong, or your technology proves not to be right, or you don't have the right talent and the right chairs. Here's something I learned at Blackstone. One of the things they look at when they acquire companies, not just financial companies, any company, they believe that there's somewhere between 20 and 35 key roles in every company. And they're not necessarily by title, right? You and I are in the mortgage business. It could be the trader on your cap markets desk who actually executes trades. They may not have a VP title, but about 80% of your revenue flows through their fingers every day. That's a pretty key person. And if you have the wrong people in one of those 20 to 35 chairs or multiple chairs, you could have the great plan, tons of capital, and it could all go to hell because you don't have the right talent with which to execute and deliver on the promise. So that's the other thing that can go wrong. Now, I happen to think that Rocket, Coop, and Redfin have a lot of great talent. I think Guild and Bayview, two of the smartest operators through this last 3 years, very smart asset acquirers on the Bayview Lakeview side. And I think Guild has done as good or better of a job navigating this process over the last 3 years than almost anybody in the business on the distributed retail side, right? Think about it. I mean, they're a distributed retail IMB who has grown and for the most part maintained some level of profitability through the process. Okay, I have to applaud.
No question. They've been able to pick up market share.
Right.
And when I say comeback story, which I mentioned,
yep.
Well, first of all, we all are comeback stories. Anybody that has made it.
Exactly. If you're here today, you're a comeback story by some definition.
I mean, just understand that, take that with a grain of salt. But there was a time where, Guild had to make a pivot where they were losing a lot of people because they weren't willing to have a P&L model.
Right.
I know this because we had 5 or
Yeah.
6 very substantial branches come to NFM. And at that time, the sense was really out there that they were on the ropes. I'm not saying they were going out of business. Clearly, they had deep pockets, and I'm not saying that. But for them, all I'm doing is underscoring how incredible it is and what kind of leadership they must have to be able to take a moment like that, to regroup, to create a P&L model, to retain the people that were left, and then go on a buying spree and be able to acquire all these people. And by and large, it was successful.
That's
A
correct.
lot of these acquisitions, it's quite remarkable. It's a unicorn story to me.
Yeah, look, I had a mentor who used to talk to us about this all the time, which is the ability to be effective in vagueness, meaning where you don't have all the answers, where it's not clear what the future holds, where it's not clear what the rates are going to do or what the Fed's going to do or the political component or tariffs, right? All these things. The Middle East today is on fire, right? So there's a whole bunch of things you can't predict. The question is, can you have a toolbox of competencies in your senior leadership that allows you to pull the right tool at the right time to focus on the right issue? And I have to give Guild, Bayview, there's others. I think you guys have done a great job at NFM. I think there's a number of companies where that exists. And there's another group of companies that I think are, to some degree, I don't want to call them one-trick ponies, but they're effective in one environment. And today, as you know, the environment can change between today and Friday, right? Who knows what the chair's going to do? Trump was beating up Powell this morning, calling him a fool and all this kind of stuff. I don't think it's helpful because the last thing
he called him stupid.
Yeah, the last thing the Fed's going to do is bend to political pressure, because what they know is you want to see the 10-year take off and go through the roof. Let bond buyers think that the Fed is bending to political pressure.
Yeah, true. All right, before I let you go, you said a lot could happen between now and Friday. Obviously, that's too short of a window to ask you about, but you've hinted in this conversation that we should expect to see more deals being made. I know you're involved in several deals at all times. So without mentioning any names, what do you think we're going to see, and when in the next, I don't know, pick a window, 3 months, 6 months, a year?
Yeah. To your point, I'm not going to name any names because it's unfair to the companies. And there's a lot of deals that get talked about that never get done, right? And in some cases, there's that old country and Western song, right, where, thank God for the decisions I didn't make, right, in the process. So there's a lot of that happening. I think you're going to continue to see capital flow into our space. You're going to see big players making moves either in mergers or acquisitions coming together. I think the Rocket Redfin Coop thing is a bit of a model for the future, where you have, this kind of portal with tons of leads, for lack of a better, term, huge dominant servicer and a great originator come together, pour capital in, wash, rinse, and repeat. I think you'll see some of those deals get done. And I think it's not just the $700 million a year retail originator that wants to either get out or become something bigger. I think there are big players and large capital thinking about what's the next 10 years in the mortgage space look like? How do you combine these pieces and connect the dots to take advantage of that opportunity in the new world? And you mix in technology evolution, and there's going to be a lot of bets made. By the way, I think some of those bets will not work, and some of them will prove to be dominant players. I think to some degree, if you and I are sitting here 5 years from now having this conversation, one, I'll be really old. And then two, I think we could have some dominant players in the business that we can't see today. Meaning, look, in Amazon, one of the big tech organizations could come together with its customer base, a discount approach, delivery, buy some of these pieces. And I'm not sure at the top of the house where you see some of these big players coming together that you couldn't see some of those combinations ultimately combine to something even bigger.
Easier said than done.
Easier said than done. No doubt about it.
It's one thing to jump into this space. A lot of people don't understand just how nuanced it is.
Well, and also the cultural aspect.
Yep.
It's what I call the social aspects of the deal. That tends to go unfocused on and by many acquirers and or sellers. And in my own experience, it's the thing that makes it work over time. When Cherry Creek, I think Rick said it on the stage the other day, when Cherry Creek sold to Guild, they had one buyer they were interested in because they believed the culture was a match.
Yeah. Brian, this has been amazing. I hope to have more of these conversations. I like to shake up, and I always love talking to you and encourage people
to listen the opportunity.
To your weekly roadmap every Friday.
9 a.m. Pacific.
Yeah, so it's 12 o'clock Eastern.
Yeah. By the way, if you're listening to this and you want to get, we'll have up on my LinkedIn and on our website an ability for people to come in and listen to Mike Frattantoni on Friday, even if you're not a subscriber, to kind of get his update on the market. We're planning a Titans event here in August where I'm going to bring back some of the superstars of this last year from the weekly roadmap and do a longer event where they can be more explanatory of their tactics. So I appreciate the call out on it, and love to have you back as well.
I want to just commend you on your desk behind you. I've seen it a lot more messy than it is right now. So it looks like you or somebody is going to.
No, I got it all stacked up behind me from where I'm sitting. That's all. It's just a little.
I like it. Well, look, just so you know, it looks a lot cleaner.
Yeah,
well
thank you.
Brian, great seeing you. Thanks to Donna Chachevsky. She's the greatest, always making these things work on, and in some instances on very short notice.
Yes, like today. So.
Yeah. Have a great rest of your week, everyone. Hope you enjoyed this. We'll talk soon. Thanks.
All right, great. Thanks, Greg. My best to you.